You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Sean Brodrick, natural resource specialist at the Oxford Club. His website, investmentu.com. Welcome to the show, Sean.
It's always good to talk to you, Jim.
Oil prices were on quite a steep rise, not so much anymore.
Yeah, well, from around February 12th to March 13th, because I just did a chart on this, the price of West Texas Intermediate was up 41%, and the price of Brent was up 45%. That's a heck of a rally in a month, and so people need to really take up and just take notice of that. The thing that provided the initial spark was the agreement between Russia, Saudi Arabia, and some other OPEC members to freeze production at what they had produced in January. Both Russia and Saudi Arabia had hit highs in January, so that's not that surprising. I didn't think that agreement was worth the paper it was printed on because Iran said that it wasn't going to be in that agreement until it raised production, and Iraq wanted all these guarantees that no one's ever going to give it, and that's where most of the growth has come, is from Iraq. But you know what? The market sees on that may be indicating that the market was oversold anyway, and so you just needed some kind of spark to send things higher. Then some other things fell into place. We got news from Reuters. One of their analysts, John Kemp, did a long study of the International Energy Agency numbers on how much oil is produced, stored, and used, and he found 550 million barrels were not accounted for. And so that means either someone's storing a lot more oil than we know about and not telling anyone, which is possible. China could be up to something. Or the world isn't producing as much, or it's using more than the IEA thinks. Either way, what that last option would mean is that that the supply-demand equation in the global oil market is not nearly as far out of balance as people thought. So that could come into balance quicker. And I think that's one of the things that also pushed the price of oil higher. Then we've had spot outages from certain OPEC members, but also we have Venezuela as it's in an economic crisis, because of the low price of oil, but it's really spiraling into a debt crisis where it might not be able to pay its debts. If that happens, that's going to take at least 10% of its oil production off the market immediately, and depending on how the crisis goes, more of its oil production could also be affected. So I think that the market is looking at the risks and saying, you know what, there are some real risks to supply right now. And so that's what drove the price up. Now, and I won't take too much more time with this, but people have to understand how volatile this situation is. Because what could happen is if the price gets, say, in the $50 to $60 range, there's a whole lot of drilled but uncompleted, they're called DUC wells, all across the shale plays in North America. In the U.S. alone, there's close to 4,000 of them. And so those wells could be brought back online if it gets to a price where the companies that drilled them can start to make money off them. That would put a lot more production into the market, and that could send the price, at least of West Texas Intermediate, down lower. So there's a lot of volatility here. I think that if things go wrong, we could see a price spike at the gas pump this summer, and that's what my recent column for Investment U was about, and about ways you as an investor could play such a spike. But people shouldn't look for things to be unidirectional. I know oil fell for a long, long time, so people might think, well, if oil fell for so far that long, then it should swoop back up. But no, we could see a real bounce around here where things go up for a while, and then new supply comes in, so it goes down, but then yet another one of these boiling points in the global market, just hits. And so then some, more supply is removed from the market. So I expect things to be extremely volatile for oil for the rest of the year. But I do think it is encouraging what we've seen, that at least some kind of bottom is in. And so that's pretty good. So that means that if oil really dips again, maybe you can start to pick up some of the stocks which you put on your shopping list if you've been listening to me during this crisis.
One of the things driving gasoline prices is the North American driving season has started early because for most of the continent, it's been a very mild winter.
Yes, it has. And there's that, and that has increased, that's increased demand for gasoline in the U.S. by about 7% year over year. Meanwhile, storage is only up about 4%. So people are starting, they were really worried for a while that, we were going to have all this product being stored in a store, and where were we actually going to put it? Now we're starting to see that turn. And so that change in sentiment actually affects the price more than what's actually happening on the ground. It's what people are anticipating will happen in the future. And right now there might be enough demand to soak up all that extra supply. The only caveat I would give on that particular thing is that if prices go up enough, that will start to affect people's demand, of course, and so that's something to keep in mind.
Right. You make money at low prices, but there is a break-even point and then the stupid point.
Yes.
Natural gas prices have been depressed for quite some time. I heard a U.S. natural gas pipeline company has actually gone bankrupt because of the low prices. Well,
yeah, see, because here's the thing is that they built these very expensive pipeline networks on the plan that they would have these locked-in contracts from oil and gas producers to put product through those pipelines. And I mean, these were contracts where you had to pay anyway, whether you used the pipelines or not. Well, those producers have hit a wall, and many of them are actually going bankrupt, right? And so as they go bankrupt, they're canceling these contracts. This hurts the master limited partnerships, which own those pipelines, and so you get kind of a cascading effect there. That may not be over. I've seen a couple of stories, hinting at maybe the worst is over for the pipeline companies. We can certainly hope so, but as long as they have problems servicing their debt, then it could be problematic. You can try and pick some up here, but do your homework and check into can they service the debt they have with the existing contracts they have. What other big contracts do they have that might get thrown out the window if, like, somebody goes bankrupt? That's still an iffy situation, which is why you can find bargains, because people are so scared of that space right now. But that is something to certainly keep in mind.
Again, the old do your research before you buy anything.
Yes.
Gold and silver. Gold's had a great run, the price down today, but is that something that's just a minor blip? Well,
a lot of this, I think, there's a lot to it. We have seen the price of precious metals rally as central banks around the world are moving more and more toward negative interest rates. Not the U.S. central bank, and we'll get to Canada in a minute, but in like Europe and Japan and like stuff like that, they've gone to negative interest rates. And so while the banks haven't passed those through to customers yet, the fear is they will. And so people are acting on that fear right now. And so if the banks do pass those through to customers, let's say you have $1 million in the bank, which some people do, and if you just left it alone for the year, if the negative interest rate was at minus 2%, you'd end up with losing $20,000 even though you did nothing with that money. That's how so because of that, gold looks better, because one of the arguments against gold is it pays no interest. Well, right now, much of the government debt in the world doesn't really pay interest, not any interest to speak of. So gold looks good because it also has that safety contingent, and so I think that's one of the things why we've seen people move into gold. Now, the Bank of Israel is expected to go to negative interest rates this year. Canada could join them. There is some talk of that. And again, the banks tend not to immediately pass this on to customers. You don't have to worry about losing money right away, but this is a perceptions game, and people worry that will happen down the road. So just keep that in mind when you're handling your own money in a Canadian bank. The U.S. is going in the opposite direction, or at least that's what people think. And the Fed has dropped hints that the economic news is good enough that they're going to have at least one more rate hike this year, and that's really supported things. That's really supported the U.S. dollar going into the into the meeting that the Fed is having right now, and they'll make their rate announcement, their outlook, on like Wednesday. So when we wait for these meetings to unfold, this happens every time, by the way. Usually stocks sell off, and that's exactly what we're seeing now. Gold goes down. Unless they say something bad in that like rate announcement on Wednesday, I would expect stocks and gold to both rebound from that. I would expect them to go higher. We'll have to see how it plays out, and certainly it is almost like gambling because we're trying to read the minds of the Fed governors, right? There's not a lot of fundamentals there. We're actually trying to read someone else's minds. But I'm not sure what the Fed will do. I think they should leave rates low, not because so much of the economic conditions in the U.S., which are actually pretty good, but because we seem to have gotten into competitive interest rate devaluation with other central banks in the world. And the more they do it, then the more of these funds sloshing around the global financial system flood into the U.S. dollar because they want something that pays some kind of interest, right? And so that's a real problem because as our U.S. dollar gets too strong, it really hurts our exports and that kind of thing. So I think for that reason, to preserve the export strength of U.S. companies, then the Fed should really not hike rates and should indicate an easy environment going forward. That doesn't mean they'll do that. In fact, they probably won't. But they'll probably be smart enough not to, throw some kind of hand grenade that's really going to knock the market off its feet. So I think that everyone should watch what happens when the Fed makes its interest rate announcement, look at it in the rearview mirror, see how things finish that day, and that will probably give you an indication of where things will go for the next few weeks.
We'll have more with Sean Brodrick right after the break.
Bird Dog, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Sean Brodrick. Sean, I noticed on the Equities board, companies like Pepsi, McDonald's, and Costco, their share prices were going up when everybody else's were going down. Why is that?
Yeah, well, those are broadly called the consumer staples. And I even have a couple of them in Oxford Resource Explorer, and they're doing well. And the reason is because people are afraid of a recession. Despite the good economic news, there's a general sense of fear, of dread. Part of what I think part of that is being stoked by the fact that economies around the world are having problems right now, so people worry that, some of that will come home to roost with us. The other part is our political process. At least one of the political parties has a vested interest in making people feel bad about the economy right now. And I think that feeds into, people's subconscious, and they start to worry about things a lot. Now, maybe we are headed for a recession and I just haven't seen it yet. That could be the case. Or maybe this is just a trend that will probably play out through at least in November because that's when the election is, right? But it might actually create some kind of a bargain hunting opportunity closer to the election simply because, things aren't that bad. So we'll have to see how that goes, but I have no problem putting consumer staples into my subscribers' portfolios, especially if they pay a nice recommendation, because I expect the S&P 500 to be mostly range-bound this year anyway. I'm not expecting a lot out of it. We haven't seen the earnings growth that would point toward higher prices. We have seen some recovery in the energy sector, so that's good, but the rest of it is kind of growing slow. So I don't expect the S&P 500 to actually finish the year down, but I would expect it, to be up within maybe 5%. And if you look around hard enough, you can find stocks that have a combination of yield and potential price appreciation that can actually beat that 5% pretty easily. And so I don't mind having a few things in there because, you know what, I could be wrong. We could be headed for a recession, and if that happens, then you want to be in the safety stocks. And these safety stocks tend to be consumer staples. Many people think that it's utilities, and some of them can do quite well, but broadly speaking, consumer staples do better than utilities when things really hit the fan, because there are certain things everyone always needs to buy, whereas if economic activity goes down, then the amount of power that the utilities sell will also go down. So just keep that in mind. That's kind of a thing that could play out through November and maybe the end of the year.
Gold and silver, short, mid, and long term.
Oh, boy. They asked me the same thing on on CBC. Everyone hates making those predictions, but I will tell you this. I think that we saw a nice rally in gold and silver. A short-term correction would not surprise me here, but the intermediate-term trend in both gold and silver has turned more positive. And because of that, I think you can use pullbacks to add to positions. I like gold miners over gold itself because the right gold miners, the ones that I want to buy, they're leveraged to the price of gold. And so as, let's say, gold makes an 18% move, which is pretty good, but the company that I might recommend, its profit margin makes like a 30% move. So you get that leverage in there, you get that working for you. I think you can really buy things on pullbacks, and you can really do quite well.
Any other areas that we should be looking at right now? Say auto parts. I've seen that they're also going up in shares.
Yeah, well, I'll have to spend some time figuring that one out because auto sales have been great. Now, it has been driven by subprime loans in like autos, and I know many of your listeners know that, and I don't want them shouting at their radio or their computer when they hear me say that, auto sales are booming. There is an asterisk there, which is that they are making the loans super, super easy and super, super cheap. Maybe that has the same kind of effect that home sales does, which is, that increases sales at like Home Depot and Lowe's. Maybe auto sales increases auto parts. I have no idea, but that is something worth watching. There are actually conflicting indicators about a bunch of things in the economy right now, which is why it's partly why things can be so scary, because people will hear some piece of news about the economy and it scares them quite rightly, and so they think, oh, things are bad. But really, you have to look at things overall, and the overall news is actually pretty good. It's and in fact, high auto sales is one of those things that I'm talking about. Auto sales are doing very well. So you put that together with the other economic indicators, and things are looking up. One thing that was low for a very long time was inflation. We're starting to see some life in that, right? We're starting to see inflation numbers that are starting to perk up, and something that will drive that is higher oil prices. And as we talked about at the beginning of your show, the price of West Texas Intermediate, the U.S. crude oil benchmark, rallied 41% in a month. So of course that's going to be inflationary when that comes through. That'll have, all sorts of other consequences in the market, in things like gold and stuff like that. So that's something you should keep your eye on as well.
Sean, thanks a lot for chatting with us.
It's always great speaking to you, Jim, and I hope people find this useful.
My guest has been Sean Brodrick, Natural Resource Specialist at the Oxford Club. His website, investmentu.com. Check out his best-selling book, The Ultimate Suburban Survivalist Guide, The Smartest Money Moves to Prepare for Any Crisis. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.